are. My name is Lisa Rafter. I am the publisher of ABF Journal, and I'm so excited to welcome you to today's ABF Journal podcast. And I'm mostly excited because of who our guest is today. So I want to introduce everybody to Andre Hakkak. Hi, Andre. Thank you so much for being with us today. And Andre is the CEO and founder of White Oak Global Advisors, a leading alternative debt manager specializing in originating and providing financing solutions to small and middle market enterprises. White Oak is a significant player in secured finance, and Andre recently published a white paper highlighting his insights on asset-based clarity. The paper draws from White Oak's 25 years in the industry. Notably, their on-balance sheet of business is the fifth largest factoring company in the US. So let's begin. And again, welcome today to our podcast, Andre.
Hi, Lisa. Nice to see you. Thanks for your time.
Yeah, of course, you bet, and your time as well. So where I want to start us out today is, can you just give us a quick overview, Andre, of why now? Why now is the time for this asset-based clarity?
A lot of reasons. First of all, both on the supply of capital and demand for capital, so the timing is very good. When we think about the supply of capital, I would say a lot of people are looking for alternatives to traditional direct lending, which is providing leverage to private equity buyouts. So the volume has dropped significantly over the last 18 to 24 months as interest rates have risen. Cost of capital is higher, and so there's a lot of reasons why the liquidity has dried up in those markets. To substitute that, what we've seen is because of the high interest rates, in particular the insurance companies, most of the folks that manufacture products to sell risk, the most prominent product being fixed annuities. People love to sell fixed annuities today, and people like to buy fixed annuities today. So given the fact that SOFR is at 4.3%, and you can get a fixed annuity for 5 years or longer at 6%, or even higher than that, 6.5%, 7%, people will lock in their capital at today's rates. So the underwriting for products that are higher interest rates is creating a huge demand of capital for interesting products that can provide such high rates. So there are many firms out there with Greek god letters, for example, that are picking up $8 to $10 billion of premiums each month. So if you think about, it's called 10 billion times 12 months, 120 billion of cash being generated, you have to start generating yield immediately. You can't just park it somewhere and like a money market fund or a treasury product getting very low rates at 4% or less than that. So you have to start generating higher yield, and that for that reason, you have to manufacture and look for opportunities in different pockets of credit. Now, when we think about what's the easiest product to scale, asset-backed is a fun area to look into. And the word asset-backed has so many different connotations to different people. So that's why, we came out with the paper that the folks that are manufacturing asset-backed product are very clever because they dropped the word S out of ABS. And the word asset is attractive. The word backed is attractive. Asset-backed together sounds very comfortable, confident, and secured. But it's nothing more than securitizations of cash flows coming from a host of products, from automobiles to consumer, to credit cards, to you name it. There's probably 12 different categories that can rattle off. So those products are usually generating or originated by either banks or credit cards or other intermediaries, and they're packaged by investment banks typically, and they sell the risk typically to insurance companies and banks in different tranches of ratings, etc. So what White Oak has built is loan products that more are closer to a bank capability. So asset-based lending is lending against the working capital needs of a company. So receivables, factoring, invoice finance, accounts payable finance. And also asset-backed is more of leasing products. So these are fixed rate, longer duration products. So when we go to the market of capital raising and or introducing our capabilities, we get a lot of confusion and get compared to ABS. And that's where, it's not a frustration. I think ABS is a wonderful product in the portfolio, and so is what we do, asset-based and asset-backed. Well, we thought we could bring forth to the market some clarity. We're not saying one is bad or one is good. It's just information so that the capital allocators understand the differentiation, the pros and cons, and also the liquidity parameters for the different products that are out there in the market. So that was really our intention.
Completely get that, and I get it. Where we are as an industry, and why that clarity is important and needed. So, in the white paper, you reference the nearly $5 trillion AB market, and it highlights the diverse landscape within it, which you talked about, from traditional, as you said, ABL and asset-backed lending against fixed assets to asset-backed securities and specialty finance. So you talk about that whole spectrum in the white paper. And if you could talk about, you referred a little bit to this, but I would like to hear a little more about it. What are the crucial distinctions between these categories in terms of risk profiles, underlying assets, growth drivers, and investment characteristics? So I know that's a lot. Want me to repeat that?
No, I got it.
Okay, good.
I've
Good.
only been doing this for 30 years, so
So
I
you get
can.
it. I love it.
So look, the key parameters is the underwriting and the risk, obviously, because the pricing of risk is driven by the risk. So that's an easy, fun thing to
Yeah.
say up front. So from our lens, and this is just our lens, when we think about working capital assets like asset-based lending, such as receivables, factoring, et cetera, it's a borrowing-based loan. So a lot of people, it's very topical right now. People say, well, what's the impact of tariffs and what industries are more susceptible to tariffs, et cetera. And it's clear, you don't have to have an MBA to know that consumer discretionary and consumer durables are probably more susceptible to tariffs, as an example. And there's a reason why I'm going to the tariff angle to discuss ABL. If you were a term lender to a consumer discretionary company and your products are produced somewhere in your supply chain in Asia, I won't, wink, wink, China.
Right.
I would say you're going to have a lot of pressure on pricing, right? Whether it's through tariffs or supply, whatever it may be. However, if you're lending as a receivable, where you've already sold your goods in the consumer discretionary sector, and you're collecting cash from your debtors, that is a safe product, right? So the underwriting, I would say, for ABL, asset-based lending, is predicated more as an advance rate to revenue. Now, let's hop over to asset-backed lending. So you're talking about collateral, such as fixed assets versus working capital assets. The fixed asset world, everybody has fixed assets. And the beauty of fixed assets is, as a lender, as a non-bank lender, we're positioned really well today, because from one end, banks don't want to be lending products that are equity-like. So as a lessor, you own the asset and you lend it to a lessee, right? Essentially, it's an off-balance sheet trade. Where if you're a bank, you don't want to own the asset. You're not, you shouldn't be owning aircraft and machinery and equipment and trucks. You should be a financier to it. But thankfully, there's been a lot of consulting firms over the last 2 decades that have gone to these companies and said, be asset light. Don't invest in a dumb asset, whether it's movable or fixed. Put your capital into growth areas such as IP, IT, sales and marketing, product development, research and development, et cetera, et cetera. So a lot of businesses would rather not put their good cash to use in a fixed dumb machine. Now, some machines are smart, but let's call So that's really created an opportunity for firms that are looking for longer duration, where you lend to a loan to value analysis and you try to accelerate your amortization faster than the depreciation rate of the asset. So that underwriting is completely different than asset-based lending, where you're lending at a discount to cash. That churns every 30, 60 days. Now, let's do the third hop to ABS. I'll be politically correct and say asset-backed.
Yep.
So the ABS world is completely different underwriting. It's what I call the solution to pollution is dilution. That's one of my favorite lines. So it's the masses, right? If you have, for example, on the consumer side, a FICO score of, I don't know, credit cards of 700 or above, or you can say 700 and below to 600, your risk profile goes up. If you go 600 to 700, which is a riskier profile than 700 and above,
Mhm.
but we've learned that investment banks and have been very clever in tranching. So if you tranche 600 to 700 and make an A, B, and C piece, you can risk rates and from both a rating standpoint and also from a cost of capital standpoint, different tranches. And we've seen the benefits of that in good markets. For most people that are much younger, they've never experienced the great financial crisis or the squeeze in early 2000s or the squeeze in 1991 or et cetera, et cetera. It's been one big party for the last 19 years. People forget that some of those tranches do hiccup eventually. And when you have a lower tranche get impacted with potential losses and delinquencies, et cetera, it does trickle up into the rating and the cost of capital for the higher tranches as well. So you trade at a discount to par, as an example. So I would say the underwriting, I just picked FICO score. It could be automobile, it could be many things, but I just picked kind of consumer credit cards as an example. But these are scalable products, and for the most part, the upper tranches have held up nicely. Even during difficult times, they recovered. So I would say the underwriting is more of the masses. You're doing big pools of autos, and it's not one consumer. It's going to be thousands and thousands of people that have a loan with a bank, and the bank packages it up. They sell it off their balance sheet. They got the origination fees. They get the servicing fees associated. They still have the client contact, but their risk is off their balance sheet. And it's held by an insurance group somewhere in the world, or a fund manager, a GP raises a fund called AB Fund. And it's held by 30 state pension funds.
Well, that was a great overview, and the example you gave, yeah, really does answer the questions that I was asking regarding the distinctions. So let me ask you about differentiating asset-based lending, ABL, as a traditional working capital solution and asset-backed lending against fixed assets. So in that differentiation, let me ask you this question. What are the fundamental differences then in the risk return profiles and underwriting processes for these two types of lending? And why might one be more suitable in different economic environments?
Good question. I answered some of the underwriting in
Yep.
the previous question earlier, but I would say, look, if one is anticipating interest rates to go down, and you are comfortable with the underlying assets of a fixed or movable asset, and you were looking for a fixed rate, flat, that's a great place to be, to lock in a fixed rate for a long period of time, 5 years, right?
Yep.
So if you look at the forward curve on SOFR, you're looking at 3.8, 3.9 in the next, call it 12 to 24 months, maybe even lower, 3.7. So the forward curve is showing a lower rate environment in the future. Who really knows, given the tariff dynamics right now? Nobody, the best economists, half of them will get it right or wrong. But let's assume the forward curve is a good indicator of lower interest rate environment in the future. So if you're underwriting to a spread of, call it, I don't know, 4% for fun or 3%, and your fixed your SOFR rate is 4.3 today. So 4.3 plus 3%, you're kind of in that 7.3% level. That's a variable rate, and that's probably a 3-year duration product. Now, if you can get a fixed rate product at 8%, fixed for 5 years, when you know the forward curve, your 7.3 is going to drop to 6.3, you may say, well, gee, I like that 8% fixed because it is a higher risk product, because fixed rate for asset backed, you're doing loan to value analysis again versus cash analysis with turning every 30, 60 days. So, you pick up more risk, but you're protected on your 8% for 5 years. Now, if you are a money owner, that's liability driven, meaning that if you're an individual and you're in your retirement age, you'd like a high coupon without variability, or you're a pension fund and your actuarial rates of returns are fixed at 7.5% in order to meet your liabilities for next 25 years, then that's a great product to put your money in and sleep at night at 8%. So that's really where the differentiation comes from the money owner perspective and a risk standpoint.
Yep. Thank you. So let's look a little bit then about, there's a historical dominance of banks, as we've talked about, in asset-based lending, but now, you noted earlier, there's also a growing presence of non-bank lenders. We're all seeing that. So what do you think the unique advantages are that the non-traditional players bring? And what are the primary drivers behind this type of shift? And, examples would be, of course, regulatory changes, evolving corporate preferences, etc. But what are the primary drivers behind the shift regarding asset ownership?
I come from a viewpoint that banks are and probably will be the continued dominant lenders in the world. There's this viewpoint that banks are dinosaurs, they're dying, they're this or that. Regulation is going to kill them, choke them, all that. I don't really believe all that. I think banks have been around for 600 years. They'll continue to exist. Their cost of capital is still efficient, even though they have a big branch network, et cetera, cost infrastructure. So I would say the banks will continue to be the dominant lender. Banks like groups like us. There's 5 or 6 players right now in the GP world, the asset management world, that have a product capability like this. And the banks give us big leverage facilities. So, for example, the Wells Fargo's of the world give us Ares and Eclipse, which is Mass Mutual Bearings, and a few others, Midcap, Apollo. Like, these groups are the dominant ABL non-bank lenders, but the banks already have a toe in us because we can't revolve. The banks can. So they view us as an origination channel that they get access to deals where we take first loss and they take second loss, right? So the banks are intertwined with us already. They're not going anywhere. And we can, because we're able to take that first loss, we can be more flexible. We can give a higher advance rate than a bank can. We can have higher concentration limits than the bank can. Even though the banks put boxes around us because of the leverage facility, that's like another investment committee level. There's the GP investment committee, there's the bank kind of restrictions, which is good. They put guardrails around us. Not say all the guardrails are right or wrong, but there are guardrails around us. But we also can, for example, maybe lend more into inventory than the bank can. So we work in concert with the banks. We're just another origination channel for the banks.
Yeah, I hear that. I get that. So the working in concert is really what you're saying at the bottom line of it all is the shift. And you see that, like you said, going on, continuing forever. So let's talk about, I've read and heard you describe asset-backed securities not as new paper, but as a shift in buyer demographics. So when you think about the historical context, which you've been talking about, particularly the role of asset-backed securities prior to the '08 great financial crisis, and you think about it from that perspective, what are the key differences in the structure, underwriting, and investor base of today's ABS compared to the pre-crisis era? And what lessons have been learned to mitigate those very risks?
Uh, wow, there's a lot to unpack there. So look, if the color is green, still green, right? It's you can see the shadow of the green or be in the front of it or have light run through the color in different shades of green, but the green is still green. Uh, the fact is that I still have a credit card, and the fact is consumers get a loan against their cars if they need it with a bank, and students will need a student loan. Or if you think about the practical needs of our ecosystems and societies, that need has not changed. Having an iPhone has not changed the need of the services that we need. So the need is there. The risk is for the most part being originated by the banks and or niche providers, right? So mortgage service providers as an example, right? So these services have not changed. They've been around for 50 years. That's not changed. The buyers of the risk have not changed. Mutual fund companies, to insurance companies, to even banks, they're still buying the risk of ABS today. The only thing that's different is that there are a dozen funds that have launched and saying, hey guys, in lieu of direct lending slowing down, we now have an asset-backed fund. So I'm glad that you're in fund 1 through 4 or 5 or 6. You're filled up on citruses because you're invested with 7 managers doing the same product, levered loans, essentially. We're going to show up in light of innovation and cross-selling to the same LP, a new product called asset-backed. And it's actually easier to originate than a sponsored term loan because you call the investment banks, and then instead of them just selling to the insurance companies, for example, they sell it to a fund, right? So you can back up the load, and your margins as a GP is actually higher because 2 people can manage this entire $3 billion fund as an example. So that's really the only differentiation, just another buyer universe that's opened up. And I'm not really saying that's a bad thing. That's a great thing. Diversification, you heard me earlier say the solution to pollution is dilution, right? So why have 5 citruses in your portfolio? We can have a banana and a coconut. What White Oak does is we show up not doing ABS, but we show up with a passion fruit and a pineapple, acid-based, acid-backed, and a medley of cherries. So that's really our positioning.
Okay, good. I like that. I get it. So looking at your experience, White Oak's experience across secured finance, including traditional ABL and trade receivables securitization, what do you think the critical factors are when you consider evaluating credit worthiness and potential risks with lending against different types of assets?
Underwriting inexperience. So that's the bottom line. We've seen we've seen different animals in the zoo. We were surprised when we saw a Cerberus three-headed duck when a fourth-headed duck showed up.
Right.
Like, wow, we thought we saw it all. My gosh. So I think that's just a journey of life, and I still try to teach my teenage kids to respect your elders because they experience things more than they have. So yeah, look, it comes down to underwriting. That's the key thing, right? And we're not afraid of challenging stories.
Mm.
A bank's trash doesn't mean it's trash. It could be our treasure.
Yep.
So we have a lot of tools that we can mitigate downside risk. So in ABL, for example, if you're dealing with a non-investment grade counterparty and you have security interest on each cash receivable that's coming from a debtor that is investment grade, and the cash is locked boxed into our bank accounts, we have a direct lien on that cash. Cash is king. That's a cliche, but it's true. So we can mitigate against those risks. That doesn't mean that the company can't go bankrupt. That doesn't mean that there could be fraud. It happens. But we have become better at detecting it early. And we watch those cash movements very carefully. And so if a particular debtor or obligor is getting more concentrated than normal, then we have bells and whistles that blink red lights and say, wow, what's going on here? Maybe our borrowing base against that group goes lower, right? So we have a lot of tools that we've developed, and our technology and systems that we developed over the last 20 years are robust. I mean, we had to spend, gosh, over $45–50 million on our infrastructure.
Mm.
That's why there's a high barrier entry to some of these products and capabilities. It's not three people coming from the trading desk of a significant blue chip bank like Goldman saying, hey, we want to do factoring tomorrow.
Right.
Can't do that. It takes people, technology, processes, etc.
Yeah. Yep. So acknowledging as you have the continued launch of new secured finance strategies, what emerging trends or asset classes within the AB universe do you find particularly compelling and or concerning? And then do you have any advice that you would offer institutional investors seeking to allocate capital to these evolving strategies?
Gosh, I could talk a lot. If I had two glasses of wine right now, my gosh,
And a
I
couple
would
of
speak your head off. um, Look, it comes down to risk and risk adjusted returns. First of all, I think investors are completely jaded today.
Hmm.
Equity markets have been robust, except for last month. Debt capital markets have been good and bad. If you're in the private credit space, your bet on sponsored credit was fantastic, highly levered, and massive upswing in debt and equity capital markets was the perfect storm for them to be a golden child. That's why every one of those platforms have been sold by now. I think we're one of the few people that still remains independent. So it's created a lot of enthusiasm, and now people have a higher bar. I was trained in a school of thought maybe 30 years ago where your PE rate at an equities analysis was going to equal your growth rate. Geez, well, that's that. Whatever I learned in my school, throw that out the window. So fundamentals have been really not the playbook. It's been a lot of hot air. So we do believe in gravity. It does work, but it takes time, and time is a man-made concept, right? So, or woman-made concept.
Yeah.
So it's a matter of progressing every day and seeing what happens. But to answer your question, I do have a biased view as to what is compelling today. And my biased view is unfortunately biased because I make this cooking, right? And I'm not here to, I didn't agree to do a podcast to sell my goods, but I would say if investors can get 7% for inside of cash receivables that turn every 60 days for a fixed income product, take your yield, be happy, and excuse my French, and just shut up. Be happy. This is good. So that's my biased view, that you're taking up double B plus, triple B risk. So your risk adjusted is fantastic. But unfortunately, people want higher, more. It's greed land. So I always say you can go up 1,000,000%, but you can only go down 100%. Right? So that's my personal viewpoint and advice. Looking at risk-adjusted returns, not just absolute returns.
Yeah.
It's a jaded market.
Yeah. Well, all of that is super valuable, and I can only imagine how much, like you said, you can go on and on and on about all of the things we discussed. But in the last few minutes remaining, Andre, anything else that I didn't ask about that's just on your mind and you would like to share with our readers?
Look, if you are a company and it's a tough time to be a business right now.
Mhm.
Your cost of capital is high, growth trajectory is questionable, and also supply chains are unprotected. So my advice for companies is don't worry about these short-term issues. Think about long-term. I think what the US is doing right now intentionally is actually very good. Bring manufacturing back to the United States. Between tariffs and shipping costs, why not control your supply chain? You don't need 100 employees we used to call them blue-collar workers. You just need a bunch of software engineers and mechanical engineers to mass produce what you need. You don't need 14-year-old children in China making your tennis shoes. It can be manufactured here. So from a manufacturing standpoint, I'd say if you are a business owner, invest in your future. From a capital owner, I would say past performance is not an indication of future performance. I feel like I have the SEC right behind me. And number two, I would say don't always believe marketing pitches and brochures. They look pretty, they look good, they're glossy, they're designed to make you drink Kool-Aid. But I would say diversification. People are now graduated at the direct lending page. Now it's to move on to the next chapter. And the chapter is diversification.
All right, we did like a 180, right? Where we started, where we ended. Andre, thank you so much. This was super valuable. I know ABF Journal readers and podcast subscribers are going to gain a lot of, valuable insights from our discussion today. So thank you again. And I think I'd like to do this again. Maybe we'll check in 6 months and see where things are at that point. So
Thank you, Lisa. I guarantee I'm going to have more gray hair in 6 months.
yes. Oh yeah, there's a lot happening in the next 6 months, right?
Yes,
Thank you
thank you for your
again.
time.
Yeah, thank you. And I will be reaching out.
Okay.
Bye-bye.